Started. Bismillahirrahmanirrahim. Assalamu alaikum, everyone. Thanks for joining us this late afternoon, evening. My name is Nadeem Mian. I'm the portfolio manager for Sharia Portfolio Canada, based here in the GTA. We actually were supposed to have this webinar last Friday, but I was battling COVID, and like the market, I wasn't doing too well. So, I'm back, and so look forward to having this. And what we wanted to do was, we did obviously want to have a discussion on this. We've been getting a lot of questions and calls from clients and prospects about what's going on. So given the events, the market events, I think this is a good opportunity for us to talk about this. And of course, I welcome all your questions in the Q&A box. You don't have to wait till the end of the presentation. You can just gladly, put the Q&A there, and I will try to get to them at the end of the presentation, inshallah. So let's get started. Okay. Standard disclaimer, everything that I say on this presentation is for educational and informational purposes only. This doesn't constitute professional financial advice or legal or tax or anything of that sort. Of course, we encourage you to speak to your financial advisor on anything that we talk about this evening. So with that, welcome back to some of our old, attendees, who, the folks that are familiar with Sharia Portfolio. Welcome back. For some of the new attendees tonight, just quickly, who is Sharia Portfolio? What is Sharia Portfolio? We are a full-service portfolio management firm, and our mandate is quite simple. We try to help Muslim Canadians reach their financial objectives by making sure that their portfolios align with their Islamic values. We're registered in Ontario with the Ontario Securities Commission. We're also registered in British Columbia and Alberta, with their Securities Commission. And inshallah, we are also planning to be in Quebec soon. So let's make dua and keep our fingers crossed, right? Inshallah. Parent company is Sharia Portfolio Canada, based in the US, been around since 2003. Like I said, we're registered with the Canadian regulators, and we operate separately as a Canadian entity. We have clients, across Canada as well as international. And of course, as our names kind of suggest, we are fully dedicated to Sharia Portfolio management, Sharia compliant management. And, again, this is the only thing we do. We're partnered up with Fidelity. We have 2 levels of service. One is more of an active service, and the other one is Express, which is much more passive, where it'll, great for, new investors who are just looking to kind of get into the market. And for that, we use the ETFs to build those portfolios. So with that, I'm just going to kind of dive in here. I gave a presentation at the end of December. It was kind of our year in review, and it was our outlook. And I kind of shared this slide where I said, Wayne Gretzky has a quote where you skate to where the puck is going, not to where it has been. And I think this is a good refresher, to be honest with you, because the puck has been moving a lot, in 2022. So just wanted to revisit, some of the slides that we gave in December, just to see kind of how we did, right? So first and foremost, I did put up a chart on inflation where I made the comment that we're in a changing environment. This has been updated. I think previously it was, inflation was hitting at a 6 or a 7, I'm not mistaken. But in any event, what's happened here with inflation is that we've gotten a post-pandemic boom in terms of consumer demand. With that, we've had quantitative easing, we've had a zero interest rate environment, and massive amounts of stimulus to kind of help the whole lockdown, pandemic situation, where the governments and the central banks really kind of got involved and put in a lot of money. So you couple, and then right now, I guess these are some of the factors that are leading to inflation, I guess, right? So of course, consumer demand, demand picks up, that's going to raise prices. You've flooded the market with a lot of stimulus and money through QE, zero interest rates, and government packages. And then now, that's on the demand side. On the supply side, you've had some supply chain constraints where COVID and some other issues have kind of not gotten that appliance that you order or that car that you ordered in time. These are, real problems, and supply chain constraints have also, been involved in increasing price. So that, and then of course, food and energy spikes. We've seen a spike up in these two, and I think as of late, we've seen a little bit, with the geopolitical situation, especially in Ukraine and Russia, we've seen kind of a follow through of pickup in prices in those two departments. So, again, these are all kind of factors that have contributed to inflation, of course, and the economy overall has been strong. So with that, that's been the main headline. So what is now, how do you contain it? And this is where the central banks of the world come in. And I'll be primarily speaking about the U.S. Federal Reserve, because that tends to be the largest market in the world, and kind of the world takes its cue from the U.S. So now what we're seeing now is we've gone from a period of loose monetary policy to tightening monetary policy. And we're on a pace now where rates are going to go higher. And this chart might actually be a little bit outdated, where we've already seen the 50 basis point hike recently. And even though this chart here from suggests that at 75, it looks most likely that we're probably going to get another 50 basis points. But nonetheless, we're in a pattern where rates are going higher, and this is primarily being done to basically control inflation, bring that inflation down. That's been the central bank has been pretty explicit in terms of why they're doing this, and at the same time try to maybe cool off the economy a little bit, right? And just a bigger term picture, just to kind of put things into perspective. You can see that if the Fed, let's just say, does get its way, and if rates do manage to get north of, say, 3.25%, you can see that it isn't exactly no man's land. We've been there before. Although it's been a while, but it will. If rates do get to that 3.25 level, you can see that that we haven't hit those levels since the global financial crisis back in 2008. So definitely a different environment. From the previous one that most investors, I think, who have been in the market for the past, say, 15 years are used to, is that we're actually, inflation and interest rates are actually real now. And of course, this is a new thing for us, where we're seeing geopolitical issues and how they've been affecting the markets. First and foremost, yes, the war going in Ukraine has contributed to stuff such as food prices, energy, things of that sort. So that's obviously been a problem. China has also been in the headlines recently, where they've been locking down on COVID. Even as recently as last month, or this month, I should say. And that's also, had some ripple effects in the market, where you got the second largest economy in the world basically saying we're shutting down. And that's caused some effects, specifically in the commodity market. And, to a longer term theme, I think, with all that's going on out there, I mean, there's an argument to be made that the world is deglobalizing. Where we are seeing things kind of, and this could be a whole different topic, but we are seeing an era or time where I grew up where free trade was the thing to do. Now it looks like things are kind of reverting back to a little bit of protectionism, and you have a situation where you have China and US, and let's face it, at some point they're converging to be two superpowers, and you have, it looks like there's going to be a camp of US American friendly companies, and there's going to be a camp of Chinese friendly countries. But in any event, I think deglobalization is real, and that can also have an effect on how we invest. I had this slide up as well, where I felt that what has previously worked in investing for the past 10, 15 years, might need to be adjusted because the weather is changing, the wind is changing. And this is the outlook that we had at the end of December of 2021, where we did expect a first half volatility, albeit I didn't expect it to happen that soon. I thought that it would kind of maybe hit us in February or March, but nonetheless, that we can put a check mark for that in terms of we got that right. Overall economic growth still remains strong, and that still seems to be the case in the sense that a lot of the economic numbers that are coming out have been on the plus side, whether it's retail sales or unemployment numbers or things of that sort. And there obviously, with all that's going on, there's been some opportunities out there. But we did make the argument that, first half is going to be tough. The bulk of the market gain is going to be in the second half. We still maintain that view. And the investment strategy that we suggested in this market was more of a barbell approach. We wanted value in there, and value meant that to be overweight energy, to be overweight healthcare specifically, and even materials. We found a lot of value in materials, and when I'm talking about materials, I'm mainly talking about mining and commodity stocks, and large cap tech as well. And large cap tech is kind of our growth play. And albeit I will say that we're not going to be right all the time. Large cap tech actually, technology was the worst performing sector year to date, or has been the worst performing sector year to date. And we also made the call that active management will outperform passive. So alhamdulillah, I think for the most part we got this call right. And this is where we are today, right? I mean, it's not a good looking chart, and I think we did kind of maybe have closed positive today in the S&P 500, but nonetheless, it's been a steep decline, especially starting in April, I guess. But it started off at the start of the year, where we had a negative January, a negative February, and then you had a little bit of a relief, and then back down in April and into May. So it really has been like four steps down, one step up. And ultimately the question becomes, well, what's driving this? Right? And I go back to what the slides that I've said is that, the U.S. Federal Reserve is arguably the most powerful institution in the world, in the sense that, they do control money and they do control monetary policy, and raising rates, quantitative tightening, and inflation are definitely big items that the markets have to adjust to. And so we are seeing some type of a resetting of valuations, and that's pretty explicit as far as why the market has been acting the way that it has been, right? And right now, as it sits, excuse me, what I'm going to go through in this presentation is a lot of it's going to be on technical things that we look at in the market, because there's fundamentals, there's technicals, and I've spent previously I've spent some time on fundamentals. I am going to take a look at more of some of the technical areas of the market, and this would be stuff such as sentiment indicators, right? And sentiment indicators can be pretty good contrarian indicators, meaning it gives you a sense of what the market participants are feeling, and based on that you can act accordingly. Now in this case, we have two indicators here. One is the AA investor sentiment survey, and what this is trying to do is basically taking a survey of some of the institutional managers out there and getting a sense as how do they feel about the market. Now, the rule of thumb typically has been, and if you can read this line, this chart on the left here, is that when sentiment is bad, which means there's a lot of fear or there's a lot of bearishness, that those tend to be times where markets have pulled back and it might be a good time to get in. and vice versa. When sentiment has been, let's just say, not bearish or too bullish, those have tended to be, times where, it's too good to last, and you tend to get a bit of a pullback, right? So the sentiment readings that we're seeing right now actually have been even worse than what we've seen during March of 2020 when we were locked down. So definitely, we're getting a negative sentiment there. And then CNN has a fear and greed index that's also similar, like a similar survey where they try to get a reading as far as, what the level of greed and fear is in the marketplace. And again, you can see that, there is a lot of fear out there. And these are, believe it or not, actually could be bullish indicators as far as the market going forward. Now these are surveys. Now these are a little bit more trying, evaluating money and some of the other markets out there that can give you an idea as far as what the fear level is. So there's two that I'm just going to speak about, and I don't, if you have any questions on these, definitely shoot them back to me. But this is the VIX, which is called the CBOE Volatility Index, and what it's really trying to do is trying to gauge the price of hedging, so to speak. Rule of thumb here again is if when this indicator is high, that means that the derivatives market, the option market, is expecting a lot of volatility or pessimism. And again, that can be a contrarian indicator in the sense that when that level is high, you can see, this is when the market might actually, bounce back. So these arrows are kind of pointing to that, where you've seen these peaks, fear levels high, and then all of a sudden you've seen a market kind of bottom out here, and vice versa. When the fear level is on the low side, that's when markets kind of have been at their highs and tend to roll over. Now these are short-term indicators that we look at when we're trying to trying to evaluate the market, especially during these extreme times, right? This is another one, put to call ratio. Again, trying to gauge the activity when it comes to put and calls. I'm not going to get too technical in it, but again, this is what they're doing, is they're using the derivatives market to get an idea as far as what some of the institutions are doing when it comes to either hedging, meaning they're bearish, or not hedging. And again, rule of thumb here is if it gets above 1 or more, that means that there's a lot of folks that are scared, and this again could be a good time to get back into the market. I think 150, when it gets to 1.15, that those are levels where they can be a little bit extreme. So a lot of these indicators, whether it's the sentiment surveys or stuff like this, where we're trying to read the derivatives market to figure out what's going on in the equity market, are at elevated levels and in some cases extreme levels, right? So in general, we're looking at these as positive indicators for the future. Now this is a little bit more this is a little bit more plain and easy to understand. So this is Bank of America, where they did a survey to figure out what the cash levels were looking like for various fund managers in the US. And you can see that the amount of cash levels that right now is sitting, it's been the highest since 9/11. So again, using the mindset, if you go back in history, what you'll see here is just kind of isolate some of these times here. I mean, we can obviously go back to April of 2020 and figure out that, wait a sec, you know what, that was just after the lockdown. A lot of these people raised money, and guess what happened? The market took off. And similarly, same thing in 9/11 and some of these other areas, like December 2008. Again, bad time, cash levels were high. Subsequently, the money gets put to work. That means money gets back into the market, it buys, and things again revert back to the norm. So just trying to put some more information out there as far as what are some of the situation, as far as what the level of fear is out there. And I know what I tend to say is sometimes fear is actually good. Warren Buffett has a famous saying where, if there's, be greedy when others are fearful, and be fearful when others are greedy. So right now, everybody is fearful. So the question right now, when it comes to the market, and this is my view, is that the debate really is, are we going to get a soft landing or a hard landing? Now, what does that mean? Soft landing is going to be a situation where the Federal Reserve gets it right. In other words, the policy that they have accomplishes the goal that they want, and that would mean that they achieve the targeted rate of inflation. So that could be, in the past it's been 2.5 or percent, or 2.5%. So coming down from 8, maybe down to whatever that number is, whether it's 3 or lower, right? So they achieve that through their policy. It could also mean, and of course, when they're increasing rates, they are trying to actually slow the economy down, and interest raise and rise do that. Now they want to slow it down, but they don't want to put it in recession, and if they put into recession, that would constitute to a harder landing, right? And labor markets get back to normal, and right now, the situation as it sits is that, previously, maybe about a couple of months ago, labor markets were tight, meaning to say that, companies were trying to hire, but they were running at full employment. And of course, when you're in a situation like that, wages will increase, and then therefore cost increase, right? So what they're really trying to do is cool the labor markets in such a way where you develop some slack, and you have labor, you have people out there looking for jobs, and that can cool off wages. Now that's a soft landing. A hard landing would really be a situation where the federal policy, they don't get it right. They miss the goal that they intended to do does not fulfill. And what that would mean is that number one, they're unable to contain inflation. So that could be a situation where they're not cutting enough, or they're cutting too much, and you overshoot in inflation and you cause deflation, and deflation is not necessarily a good thing. You can also have a situation where instead of slowing the economy down, you put into recession. That's like putting the economy into a coma. So again, a little bit of an overkill. So something to kind of keep aware of. And where previously I mentioned that they want to kind of cool off the labor market, well, they might overkill that too, and you can get an unemployment rate that is a little bit higher than expected, right? So these are stuff that the market is obviously debating right now. Is that okay? Well, if we get a soft landing, that's actually going to be quite positive for the market. And on the flip side, if we don't get a soft landing, that could actually be a negative. And the hard landing, there's a lot of talk about a stagflation, and we haven't had a stagflation, I think, in over 40 years or something like that. So nonetheless, the equity markets, and this is, I took this out of JP Morgan's report. Right now, what they're basically saying is that the equity market, the S&P 500, they're factoring in the probability of a recession at about 70%. So markets are kind of 70% priced to a recession. I guess that's what they're trying to say. Nonetheless, something to kind of keep an eye on. Now, having said that, we are looking ahead where we've seen, a lot of this bad news being reflected in the market. So we like to look at the risk reward equation here. And, you have to look back at history and see this. The NASDAQ is down about 25%. I think in action, this table might be a couple of, it might be a few days old, but a couple of weeks old. And so it might actually be closer to 30. But nonetheless, what we've seen here is this. In the past, when the NASDAQ has been down about 25% from the record high, historically, what we've seen is that the return for the next 1, 3, 6, and 1 year, on average, have been quite positive. So, for example, especially for our investors who have a time horizon long term, you're looking at a year plus at least, right? You can. History is at least on your side, in the sense that anytime you've gotten a 25% drawdown on the NASDAQ has averaged about 33.5% in the next 12 months or the next year, and with a median of 31%. And so, the historically, especially the 1 year, because we're not too focused on 1 month or 3 months even. We're obviously looking at longer term. So we like to take a look at the 1 year number, and the 1 year number is clearly telling you that, history at least is on your side. Again, we're not telling you that history dictates future, but nonetheless, I think if you don't learn from history, you can be doomed to repeat it. The one other thing that I will add to this is this. The recent high that we had on the Nasdaq, and I'm focusing on the Nasdaq because the Nasdaq is the technology, and technology is the largest component in the S&P 500, and at the same time, it's a pretty leading indicator of the market. The Nasdaq hit its high back in November 19th, 2021, and here we are at 30%, and it's May 20th, right? It's been about 180 days from the high point to the low point. The previous highs over here have been much shorter. Like the lockdown lasted basically about a month. Even the .com, right, was you've seen this big precipitous fall off, which just 25% was down in 25%. It only took about a month. And so a lot of the other corrections, right, have been very short in nature. What we're seeing right now here, right, is we're seeing basically an old school bear market. And the fact of the matter is, most people who are invested today, they're not used to this. They typically see a big drop off, and then maybe a V-shaped recovery. So we are getting something like what I would call an old school bear market, where it's taken us about almost 6 months to get there, right? So here's our view. First and foremost, what I like to say is that the market bottoms before the data bottoms, and what I mean by that is that the headlines are going to be bad, right? But if you just go back and just think about a few things here, number one, like the lockdown, right? Pandemic, like the market had bottomed in March. The news flow didn't get any better, like in March. It got worse in April and maybe even worse in May. But the market had bottomed in March because the market is always forward looking. Same thing in the global financial crisis. In the global financial crisis, by the time the S&P had bottomed, all the economic numbers, the GDP numbers, and everything that was coming in the months ahead were actually getting worse, or at the very least, so the rational really, this is very powerful in the sense that always realize that the market is looking forward. They're not functioning on today. They're trying to look 6 to 12 months and basically ask the question, are we going to be or is the situation going to be better? Or even better, is there light at the end of the tunnel? And so that's number one. And so, but having said that, I came out with my short, my intermediate, and my long-term outlook. Short term, given what's happening here, I make the argument that I think we're in the 8th inning of this downtrend. And if those people who don't watch baseball game has 9 innings, so we're close to the end, I think, of this downtrend that we're seeing here. And that's my base case. Of course, I could be wrong, but my base case is that I think we're in the later stages of this. The sellers are getting exhausted. And as I pointed out, there is massive pessimism out there. Anytime, I've been doing this for over 20 years, anytime I've seen massive pessimism, the markets have always, in more cases than not, the markets have always reacted positively. And that NASDAQ table kind of shows it. So some of the technical readings are starting to confirm this. And, what I do think is that, we could possibly get a 10 to 15% recovery. And that would mean that, the markets recoup maybe about 50% of its losses, right? Again, these are rule of thumbs that I tend to take a look at, but I can see this happening, given the market that we're in. But that doesn't mean that we're going to continue to go high. I still think we can get some choppiness in the market in the couple of months. My worst case, of course, my bear case is that, the S&P can drop further to 3,500 or 3,600 level. And I think at that point, it would become a very interesting opportunity to really get heavily invested. But nonetheless, my base case is that I think we're in the eighth case. So specifically, I'm bullish on technology. It's been the sector that has been hit the hardest, and the valuations have come down, so it looks quite interesting. Materials as well. I'm bullish on the commodity sector. Recently, what happened in the commodity sector was the China lockdown really affected some of the commodity prices because China is the largest consumer of commodities. And so with that correction, I'm seeing pretty good value in the material sector. Short term, I'm bearish on staples because consumer staples have in this market have done really well. In fact, you can make the argument that their valuations are equivalent to technology, and historically technology has always been more expensive than consumer staples. When I'm talking about consumer staples, I'm talking about the Procter and Gambles of the world, the sectors that like food, like basic people that you will use basic stuff, like food, mainly food and items like detergent and things of that sort, right? Now I've been a big bull on energy, and longer term I am, but short term I am a little bit cautious on energy. I'm not saying get out of it, but I think maybe taking some money on energy stocks right now might not be a bad idea, because I think we can get a rotation. Energy has been the best performing sector in 2022. Intermediate, short, midterm, I'm still, like I said, I'm still bullish on energy, but I think that in the short term we could get a pullback in oil prices. Maybe we drop below $100 or something of that sort, right? Midterm, intermediate, I think that the bulk of the market's gain are going to come in the second half of the year. I know a lot of people like to ask about targets. I put 5,000 there. Not just as a good round number, but at the same time I do think that we can get back to the highs of the year, which we were in January, and maybe eke out a small gain for the year. I will still be bullish energy, materials, large cap tech, and healthcare. Those are still my favorite sectors to be in for this year. And longer term, I still believe that we're in a period where active investing will outperform passive investing. I think those people at Quest Trade who put that you're going to retire 30% more, they're going to have a rude awakening, because I don't think just by simply bringing costs down on trading is going to get you to where you want to go, because I do think you have to be a little bit more active, because we've already talked about how the world is changing, right? So valuations will matter. And I think that's the other thing, is that we're navigating through inflation, a tighter monetary policy, deglobalization. These are all things that nobody who's been in this market longer, who's only been in this market 10, 15 years, they've never seen anything like this. And passive investing has worked great. But I think when you're in an environment where things get a little bit tricky and you actually have to, look at fundamentals, it's going to matter. So, valuations, I think, are going to be important. And, like I said before, we are overweight longer term energy, commodities, healthcare, and select large cap. And select large cap simply means that, we want to buy companies that can keep up with inflationary pressures, that have good economic moats, and are in sectors where we are bullish on, like for example cybersecurity. So that's kind of my quick take. I will I guess end it there, and would obviously welcome any questions that you guys have. So normally I have a moderator with me to kind of be a gateway to the questions, but let me see here. Do I have? Oh, you guys are a pretty quiet bunch. I'm actually surprised, because it looks like we get a lot of we finally have a question here. All right. Okay, I just thank you. Okay, you're welcome. All right. So any questions? What I will say, I will add that if you're a client of ours, great. I did want to, like I said, get this message out to as many of our clients as I can. the webinar is obviously being recorded, so I invite you to replay it if you like, or send it out to your friends and colleagues, whatever that would be interested. And so, one second here, the only thing I'll say is that we obviously would encourage you to visit our website, have set up a meeting with myself, at least have a discussion. If you are not a client of ours, see how we've done so far this year. Well, it looks like I do have one question here. That Sharia Portfolio filters out for over-leveraged companies that cannot do well under pressure in bad times. Only investing in the best of the best. Did our portfolio did better than the market? Okay, so I mean, that's maybe a statement or a question here, but yeah, so we do obviously filter out, we have the requirement where, we cannot buy over leveraged companies, and the debt to capital ratio cannot exceed, the 30%. Now, normally, yes, in downturns of the market, that does help us. Especially, I would make the argument that when you're in a rising interest rate environment, what that means is that, companies who are reliant on debt, all of a sudden the cost of the debt is going to increase. And so naturally, that's obviously not good for the company. It's going to hurt the bottom line. And so we do think that the leverage ratios that we use, that we're confined to, is actually going to help us out in a raising rate environment, right? So, alhamdulillah, I would say that although we're forced to do it, I think it's still, a good thing to have. So I guess I have another question here. Are your predictions for all types of models? Okay, that's a good question. Well, so if for those of you who are not familiar, we have a variety of models, anywhere from conservative, income, moderate, growth, and aggressive. And now a lot of the models, first and foremost, are based on asset allocation, how much of your money is invested in sukuk, which typically tends to be less volatile, pays an income, versus equities, which obviously is, exposure to the market. So, I mean, number one, that's first the cornerstone of the model is how much do you have in equity, right? Now, typically when we are looking at, the various models, I would say that for the most part, the prediction is pretty consistent across the board, in the sense that if I were to kind of take a look at the income model versus, say, the aggressive, there will be some similarities, but there'll be some differences as well. So, for example, the example that I use is that, okay, so in our aggressive model, for example, we have Moderna, which does not pay a dividend. It's a little bit of an aggressive name because it's a smaller company, but nonetheless, that we think there's upside to this company because, it might not be, Pfizer or Johnson & Johnson today, but maybe it can have that potential, right? So and that's also a play on healthcare, right? So, keeping to my theme, I'm bullish on healthcare. I look at Moderna, I add it to the aggressive. Now, on the flip side, if I go to our income portfolio, which is on the conservative side, or even our conservative portfolio, we do not own Moderna. On the flip, we do, however, own Pfizer as a holding. And Pfizer, again, consistent with my theme on healthcare, where I like healthcare, I will pick that sector. But maybe for a conservative portfolio, I will not buy Moderna. Instead, I will buy a company that has less volatility, historically speaking, and is a little bit more established and pays a dividend. So hopefully I've answered that question, in terms of how we select security and how that, applies to the model. Okay. Exactly. Carefully, this is good. Are you bullish in gold? If you are bullish in technology, are you bullish in crypto too? Barakallah. Okay. So, so I'll answer that question. Am I bullish on gold? I do have my eye on gold. We exited gold a couple of years ago, and it's been kind of on our radar. I think short term, though, it looks like it might pull back here. Now, the thing here is this. when you're in an environment like the US dollar has been on a nice little run here, interest rates are rising. These are all factors that would normally be, bad for gold. Um, to be honest with you, I don't presently have an opinion. I'm kind of neutral on gold right now. I would rather more focus in on industrial metals such as copper, such as, nickel or zinc, or maybe focusing on companies that have that, right? So like, for example, we own Rio Tinto in our portfolios, which is one of the largest producers of iron ore and other metals. And I'm bullish on technology, and I'm bullish on crypto too. Crypto. Um, hmm. Crypto is an interesting asset class. I don't think it's a currency, at least not yet. It acts like a risk on, or it's been trading according to NASDAQ, like it's been trading alongside NASDAQ for a very long time. I'm still wrapping my head around crypto in the sense that, a lot of the crypto bulls were talking about how, you got to buy this because inflation is going to go nuts and central banks are going to pump money and all this other stuff. Now, inflation has skyrocketed. And you know what? The central banks did pump a lot of money, but now they're reversing. And, crypto has been just annihilated, in this whole thing. I think, just put it to you this way. I think there's a lot of speculation in the crypto space. There's a lot of people out there that, don't know what they're doing, but they'll just, there's a lot of retail money that's going into crypto. And it's similar to what happened in the .com, in the sense that if you go back in time, if you can go back to the year 2000 and have this vision that this is what the internet's going to be like in 2020, that internet is the future, no doubt about it. It has become the future. However, from a financial asset standpoint, only a few companies survived, and a ton of people lost a lot of money. Now, I'm not saying that that's going to happen in crypto, but I do. It feels like a movie I've seen before, and I think that, there will be more pain before, crypto comes back. And there's a lot of things that I think crypto has to figure out: regulation and taxation and things of that sort, that, that need to kind of settle down. So I'm not gonna say I'm not bullish on crypto. I see the potential there. I think the best way to probably play it is with established coins, maybe like, for example, Bitcoin or Ethereum, whatever you want to, use. But that's kind of where I'm at with crypto, is that, if there, and from a portfolio management standpoint, we would only allocate no more than 5%, to any crypto investment, which is actually what we have right now, only about a 5-point allocation and nothing more than that. And that it's also would only be for our growth or our aggressive portfolios. We wouldn't be buying crypto for our conservative or even our moderate clients. Let's see here. Do I have another question? Your opinion on Facebook and PayPal? Well, okay. Well, we don't own, like, Facebook is owned in the SPUS, the ETF. We don't own it in the actively managed portfolio, at least not right now. I would say this: I know that Facebook is from the last quarter. I mean, it was a really horrific quarter, and the stock was down something like 30-40%, I forget. There are some issues behind Facebook in terms of its model that some of the analysts have questioned. I think here's the thing: I think what's happened overall in technology, because everything's come down so much, so hard, that there's a lot of opportunity out there. And I'm more inclined to maybe look at them than a company like Facebook. So I guess the example that I'll give you is Palo Alto Networks. This is a stock that we own in a couple of our model portfolios. It's a cybersecurity company. Now, recently they reported, but just before they reported, the stock came down a good $100 or so for no apparent reason. And you know what? For us, we'd rather be more comfortable in buying a name like that, which has come down in value, but we like the business, we like the sector that it's in, versus, something like Facebook where, it's right now it's going through some issues. PayPal, I believe, is not Sharia compliant, so we don't own it. In the past, we have owned Square, but right now we're not in it, and again, it's not Sharia compliant, so I guess I haven't really dived into the stock itself. In times of inflation, I have another question here. In times of inflation, normally gold is the king, but it's not this time. Do you have an explanation for that? That's a great question. And, this is a question that, believe it or not, within our portfolio management team, we couldn't figure it out. Like, I couldn't figure it out, in the sense that, when the central banks were quantitative easing and flooding the market, gold had a good run, but then there was a period where it just underperformed, right? I don't have a reason. It was one of those things that I just couldn't really figure out. Now, some made the argument that at least during that time, crypto was taking funds away from gold or something like that. And that could be a possibility. And in the sense that people who wanted to get into the inflation trade were now more interested in getting into crypto versus gold. And how much of that is true or relevant, I'm not too sure. But I think it's been well written by a lot of some of these other analysts that wrote on this topic, that crypto has become an alternative to gold. I think gold still has its place, and I think gold has outperformed crypto, at least for the last maybe year. So there's something to be said about that it has actually done well. Let me see if I have another one here. So I think that's it. So with that, unless there's anybody else that has a question, I think we'll end it there. So once again, Jazakallah khair for joining us this afternoon, this evening, wherever you are. We hope you attend more of our webinars, and if you enjoyed this one, and if you think that you have a friend or colleague that might also enjoy what we have to say, I encourage you to go onto our YouTube channel, subscribe, share it, and then we can go from there. So with that, I will say Jazakallah khair. Thank you again, and Assalamu alaikum.